This is GJ here, and I want to welcome you back to She Techie, where we teach women tech skills and how to start home-based businesses. So I want to answer a question that I've been asked. How can I start building wealth with little money? So if you ever felt like you don't have enough money to start building wealth, I'm going to give you some tips. Let me show you how you can, even with a little, it can go a long way. Building wealth isn't about the amount of money you start with, but the strategies you use. So you want to start with small, regular investments. Have you heard of dollar cost averaging? This is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. This approach reduces the impact of market volatility because you're spreading your investment over time instead of investing a large lump sum all at once. How does this work? When the price of an asset is high, your fixed amount buys fewer shares or units. When the price is low, your fixed amount buys more shares. Over time, this can result in a lower average cost per share compared to trying to time the market. The strategy works well for long-term investors who want to mitigate the risk of short-term market fluctuations. So say, for example, imagine you want to invest $600 in stock. And when I say stock, I'm referencing to dividend stocks, those stocks that the company pays out a portion of their earnings, either quarterly or monthly during the course of the year. So say you want to invest $600 in stock, but don't want to risk buying all at once due to market volatility. Instead, you decide to use dollar cost averaging, DCA, and invest $100 per month for 6 months. Let's see how that works. So month one, the stock price is $50 per share. So you buy 2 shares because remember, the goal is to invest $100 per month. Month 2, the price drops to $40, so you buy 2.5 shares. Month 3, the price rises to $60, so you buy 1.67 shares. Month 4, the price is $55, so you buy 1.82 shares. Month 5, the price drops to $45, so you buy 2.22 shares for 22. Month 6, the price is $50 again, so you buy 2 shares. So again, this is investing $100 per month for 6 months. And remember, I'm talking about those dividend stocks because when you stop investing, each time that company pays out shares to its shareholders, you're constantly receiving money from the company. And you want to install something called a DRIP, a dividend reinvestment program, where when they pay you that dividend, so for example, if the company is paying out 20 cents per quarter, 4 quarters for the year, that 20 cents is then reinvested back into that same stock. So instead of you constantly pouring money into it, now the stock is growing because every time the company gives you money, you're putting it back into that same stock, earning more shares. So over 6 months, you invested $600 and bought about 12.21 shares. Your average cost per share is $49.13, even though the stock price fluctuated between $40 and $60. So the benefits of dollar cost averaging is that it reduces emotional investing. You're not trying to time the market. It mitigates risk. By spreading out your investments, you reduce the chance of investing all your money at a market high. And this is disciplined investing. It forces consistent saving and investing over time. Another point that I want to make is eliminate high interest debt. For example, paying off credit card debt will boost financial health. Create an emergency fund. A small emergency fund is key to avoid financial backsliding. And use different financial tools such as apps like Mint and Personal Capital for budgeting and monitoring growth. Remember, you don't need a lot to start, just the right mindset. So subscribe for more tips to grow your wealth.